Hello and welcome to our presentation today on retirement and taxes. My name is Anthony Fagen. I am with Liberty Tax Service based in Suisun, California. I am one of the co-office supervisors here, as well as a California registered tax preparer. And we're doing this as a little bit different of one of our new events that we offer here with Liberty Tax. It's called the Liberty Tax Talk. We typically will go these out onto the field, talk with you, the individual taxpayers, about topics that are important to you. And we're doing this a little bit differently, sort of as a hybrid presentation where we're live here on Google's Hangout on air and through YouTube Live, and give you an idea of some of the things that we can do as part of our presentations. So what we're going to talk today about is retirement benefits. We are less than 25 days away, the day we are recording this, for taxes to be filed here for 2017. As you know, April 17th this year is the filing deadline. And over the next several weeks, we're going to be talking about certain topics, such as retirement and how they affect your tax return. Now, given the weather the last few days, both here on the East Coast and on the West Coast, actually, we're on the West Coast here, you don't necessarily know if retirement is in the cards because you're probably stuck in the snow or you're in the rain, as we've been having out here, or maybe even the snow up in Tahoe. But to be honest with you, I know a lot of people want to enjoy retirement. They want to take advantage of it. And they probably would want a nice, sunny, warm place to go to if they have that opportunity. But believe it or not, taxes are still going to follow you in retirement. So one of the things we want to talk about today is how are your taxes calculated and how are the tax benefits for having retirement plans affecting you this year and potentially next year as we go along with some of the new tax law changes. So let's talk a little bit about what retirement plans are out there that you could be offered. So just some general ideas about tax returns and how things go when you have a retirement plan. The key is, what are you saving money for? You want to be able to enjoy your retirement after your years at work, whether that be 10, 20, and lately, even 30 years down the road. You want to be able to get that monthly paycheck beyond what you get for your pay through your employer. So when you're offered the idea to maybe set aside monies, whether it be through a pension plan, whether it be through an individual retirement arrangement or account, as some people say, you want that extra money there for you, and you want it to work for you in your retirement years. So pensions, most everybody knows the biggest type of pension that is out there is considered a 401k. Most businesses, most larger businesses, offer that to individuals on a regular basis. You set aside monies from your paycheck, they go in, they earn money so that when you reach your retirement years, they come out. One of the advantages of having plans such as a 401k means you can actually put money in and it's tax deferred. Tax deferred means very simple. The monies are set aside. They don't show up as taxable income when they're taken from your wages. They're taken what we call pre-tax money. And every time you look at that W-2, or excuse me, your W-2, or a similar form if you work for civil service or the Railroad Retirement Board, they're named a little bit differently, but in any event, those monies come out from your wages and you're not charged tax on them. The tax is deferred. Similar plans to that for a 401k could be if you're a teacher and you are getting what we call a 403b plan. It's a tax-sheltered annuity. If you are part of plans that are called SARSEPs, that means salary reduction pension plans, maybe established by a small business, or a savings incentive match plan, such as a simple plan. Any of those plans, even a thrift savings plan if you're a federal employee, all allow you to do elective deferrals. All allow you to take money from your pay pre-tax and to be able to put that in pay into these savings plans. So it allows you to grow. So do any earnings in those accounts. They'll allow to grow over a period of time and not have to be taxed. That is, of course, unless you take money early. And we'll talk about early distributions and how it can have an effect on your taxes going down the road. The key is you don't want to take monies early because penalties can apply. And we'll talk more about penalties in 1 minute. But those are some of the things you're going to start considering and start thinking about when it comes to having retirement money in those cases. So as the monies grow, they're tax deferred to you at that point in time. Now, let's talk about when you get the money. When you get the money, you can take it in one of two ways, either periodic payments over a certain amount of time. It may come out to you as a lump sum payment in some cases. Either way, they are going to be taxed at your tax rate depending on what your filing status is at the time the money comes out. So the idea of having a retirement plan when you are younger at that point is to allow you more time to build up on that money until you retire. They figure by the time you get to the retirement age, your tax rate may be lower at that point. So taxation will be your monies will be taxed at whatever your tax rate is at that time. Typically, most deductions run between 10% on a federal level, and in some states it will vary. Here in California, it's typically around 5% of your distribution, should you have taxes taken out. Some people elect not to, and then they will be responsible for those taxes when they file. Now, I'll bounce back and we'll go talking about the distribution and how it's affecting you on a tax level. You do report it as income. There's no question about it. You do report it as income. So depending on what your tax rate is will determine ultimately what your tax is going to be in the end. It goes towards your total income. All of that is subject to tax after we take out deductions, either a standard deduction or itemized, meaning you're claiming certain items such as medical expenses, mortgage, real estate taxes, etc. Once you do that, and we look at your tax that's deducted, have you taken out enough? Now, again, typically your tax rate is about 10% or 5% on any distributions. Penalties can apply, though, if you take money out early. Now, there are certain exceptions, such as for buying a first-time home. Then that usually is limited to around $10,000. You may have unreimbursed medical expenses that you haven't been able to claim on your itemized deductions or on your tax return. Those are just two examples of hardship deductions that are allowed. Now, don't confuse hardship deductions, however, with what your plan may offer you at work. Your work offering might be very different than what the tax laws will allow. Yes, you can take money early from your plan. You may be subject to penalties of as much as 10%, above and beyond what taxes have already been taken out, especially if you're under 59 and a half. Now, in some cases, if you leave your job and the plan doesn't allow you to hold monies for a period of time, then yes, you're going to have to pay taxes. There's no way around it, really, in those cases, unless, again, you're taking money out for certain hardship exceptions. So those are the most common level of plans, and those are the rules that you normally see with taxes. Now, here's some advantages. If you have money in a qualified plan, qualified basically meaning your monies have gone into a tax-deferred style of account, you have the ability to take that money and move it to another type of qualified plan. For example, if I have a 401k with ABC Financial, and I decide I want to go to XYZ Financial. They have a great plan. It seems to be getting better returns on investment. I want to be able to move the money. Or maybe I'm going to a new job and they have a great retirement plan and I want to move it from my old plan to my new plan. I'm allowed to do that. You're allowed to do that. You can do that at any time. Just remember once a year, though, to avoid some tax complications. But in any event, as long as you move the money from your old plan to your new plan, within 60 days, your monies will go over tax-free. That's correct. If it goes from the old to the new within 60 days, it's tax-free. Now, here's the caveat, and we do see this a lot in our tax office here, as well as in tax offices I've worked with for the company. A lot of people will get that check in the mail from the old plan. You'll notice that your taxes have been taken out, sometimes as much as 20%. That's what's required to be withheld. If that happens, you have 60 days to make up the rest of the money when you move it to the new plan to avoid any taxable consequence. Otherwise, it's going to be considered a withdrawal, it's going to be considered a distribution, and the tax is going to stay on. How you avoid that is doing what is called a direct withdrawal. You go to your plan administrator, you give them all the information about the new plan, let the old and the new plans talk to one another, transfer the monies. As long as it's been done within 60 days and you do not get to see a check, your transfer is valid. You also can take it from a qualified plan and place it into possibly a traditional IRA, and we'll talk about those in a second. Again, as long as you do it within the 60-day period, there's no taxable consequence. If you don't, or you don't put all of the money in and of itself, and you take some out for yourself and do whatever you need to do with it, you still will be taxed. So keep that in mind as you do that. We talk a little bit about tax. Let's explain a couple of things about that. If you are making contributions out of your own pocket, that's considered an after-tax, either a contribution or distribution. Those monies still have to be reported on your return in this way. If you make a non-deductible contribution, whether it's to an IRA or to your 401k or other type of qualified plan, those deductions still have to be reported to the IRS on a regular basis, because that's what we call adding to your cost basis. When monies are withdrawn from those accounts, since that money has already been taxed, it won't be double taxed after. In other words, if I put $5,000 of my own money out of my pocket into my work 401k, and I'm still having monies taken out from my pay into the 401k, that $5,000, when any withdrawals are made, will come out of the account first. Any other monies will then be taxed accordingly, because they've been taxed already. They've been taxed at the time of the withdrawal at my rate then, at the time of the withdrawal. Okay, seems confusing? Yes, it can be. Bottom line is, if I put money into an account, because I did it with after-tax money, I'm going to get that money tax-free back to me. Anything above and beyond that, my earnings or other contributions I've made through my paycheck, will then come out, and those will be taxed at whatever tax rate I'm at that time. Now, we've talked about, in a general sense, qualified plans like pensions and tax-sheltered annuities. Now, that's retirement plans that you can have set up for you at work. Now let's talk about what you can do on your own for monies you can set aside. You'll hear the term IRA, especially this time of the year. You're going to hear the term IRA. What that means is I individually can set up a retirement account with my bank, my financial institution, or sometimes with my employer in order to set aside monies for retirement on my own. This is a great vehicle for individuals that either want to participate or have already participated in a plan and maybe want to try something different and have on their own. We'll talk about what happens if you have a plan at work or not in a minute. But the bottom line is you can set this money aside by yourself. How much can you contribute? Now, to backstep just a little bit, when you talk about a pension, Your contributions are going to be based on your limits are going to be based on your age and if you are allowed a catch-up provision. Bottom line, for this year, tax year 2017, you are allowed to take and max out your contribution at either the lesser of your taxable compensation or $18,000. That's if you're under age 50. If you're 50 or older, you can do it at $24,000. If you're looking ahead for next year with the new tax laws, those amounts go up $500. So again, if you're under 50, your maximum contributions or distribution, if you're looking at certain plans, you can max out at $18,500. And if you're 50 or older, it's $24,500. If it's a type of plan that they will look at to determine if you're going to have a limitation, typically that's if you're in a Section 457 plan, it's going to be the lesser of your taxable compensation or those amounts I just quoted you. And again, in 2018, this year, when you file your taxes next year, your maximum is going to be added another $500. Now let's go about and talk about, again, the IRA. Again, you set it up with the bank, possibly your employer. Monies you put in typically are done with after-tax money in some circumstances. However, your earnings are subject to tax in those cases, particularly if you do what's called a traditional IRA. That's the brainchild, the original IRA, if you will, that was established several years ago. You can make contributions to a traditional IRA until you reach the age of 70 and a half. We go back to that age for one reason. Remember, you have required minimum distributions we talked about very briefly that occur at age 70 and a half. You have to take that money or you're subject to additional tax. As far as what you can contribute, if you are working, it's going to be the lesser of your total taxable income, taxable compensation, wages, salaries, tips, etc., or $5,500. Now, if you're 50 or older, the government allows you a catch-up provision of $1,000. So now it's $6,500 that you contribute. That's a maximum. Earned income, alimony, non-taxable combat pay, those are what they consider taxable compensation for an IRA. Anything else you get, such as interest, dividends, rents, pension, and then annuity income, any other income that's not included other than the non-taxable combat pay, you don't count that. Again, it's either your wages, alimony, or separate payments or non-taxable combat pay. That's your taxable compensation. If you're married, the same thing applies. You and your spouse can both open an IRA. Again, it's going to be the smaller of both of your taxable compensation, or $11,000. If one of you is over 50, that goes up $1,000 to $12,000. If you both are over 50, you go up to $13,000. Interesting part is if you can't contribute to your own IRA, but your spouse has one, you actually can contribute to that spouse's IRA, so long as you don't go over the max and so long as you're under 70 and a half. Let me give you an example. We have a customer whose name is Richard, and he's 73, and he has $12,000 of earned income for the year. Geraldine, his wife, is 68 years old. Richard himself can't make the contribution because he's over 70 and a half. Again, when you have a traditional IRA, that's the maximum age. Can't make any contributions when you reach that point. But he can contribute that money to his wife's IRA. And at that point, because of the age, you're looking at $6,500, and that's going to count, and that's acceptable. Can I make any contributions more than that amount of money? Yes, but they're going to be taxed. Any excess contributions are taxed at 6%. That's an additional tax that's going to show up on your tax return in and of itself. But the one advantage about having an IRA that's a traditional IRA, you can deduct up to a certain amount, you can deduct the contribution you make for the year. And what that does is it reduces your total income for the entire year. It reduces down your money to what we call your adjusted gross income. How much can you deduct? Again, really depends on, do you have a plan or don't you from your employer? Without getting too much into the numbers, we'll put it to you this way. If at least one of you is covered by a retirement plan at work, and you make anywhere between, we'll say, $61,000 and $71,000, the deduction you have can either be full or partial. If you go over $71,000 and you're single or you're head of household, then you can't take a deduction. If you're married or you're what we call a qualifying widower, that means you have a child who can still be claimed as a dependent for 2 years after you file the tax year that your spouse passes away. You're looking between $98,000 and $118,000. Some can be full, some can be partial. Once you reach $118,000, then you can't take any sort of deduction. Here's the key. If you are married and you're filing separately from your spouse, you have to make under $10,000. If you go over $10,000, you cannot take any deduction at all. And even making less than $10,000, the deduction is partial. If you're not covered and you're single, head of household, or a qualifying widower, or if you are married and your spouse is not covered by a plan at work, you can take a full deduction, and it doesn't matter what your adjusted gross income is. If you're jointly, one spouse is filing between $184,000 and $194,000, again, you have the option of doing a full or a partial deduction. Once you go over $184,000, then it becomes a partial deduction. If you're separate, spouse is covered at work, and you're filing separately, unless it's under $10,000, you can't take any deduction. And even then, you only can take a partial one in that respect. Now, we talked a brief moment about non-deductible contributions. Those, by the way, have to be reported every year on your return, even if you don't make a non-deductible contribution in that tax year. That basically means you got to keep records of this every single year if you make one. And those have to be filed with your tax returns because, again, that's after-tax money. Money you put into it that are already coming out taxable, that have already been taxed, that still have to be reported, Form 8606. If you're a tax preparer, you know that form pretty well. That form requires you to report those non-deductible contributions. When those monies go away and you've already received them, remember that amount of money will not be considered taxable in those cases. Now, we mentioned before, early withdrawal penalties can apply. The same also goes for a traditional IRA. For a traditional IRA, if you take what's called a premature distribution or an early withdrawal, and you're under 59.5, you are subject to a 10% penalty. There are certain exceptions under a traditional IRA where that penalty tax is not going to apply. If you're getting the money as a result of a form of annuity, you are disabled. You are disabled. You're a beneficiary of a deceased owner's IRA. You have unreimbursed medical expenses. They're more than 10% of your adjusted gross income. And by the way, that's for this year. Next year, depending on your age, will determine if it's 10% if you're under 65 or 7.5% if you are 65 and older. If it's going to an alternate payee because of a divorce order, the legal terms, they call it a QDRO, then those monies are not subject to the additional tax. Unemployed individuals for health insurance premiums, certain premiums, distributions for higher education, distributions for a first-time home buy up to $10,000. That also includes repairs. Distributions made because of a levy to the plan by the IRS. Let me rephrase that. If the plan has been levied, then your distribution to you will not be subject to penalty tax. If you're on active duty for at least 180 days and you have to make a distribution, those will not be affected, and others that classify into that. You always can ask us if my distribution meets those items. Your plan may distribute your money for other reasons because the plan allows for it, but it may not qualify for the IRS. You can always ask us what qualifies. And as I mentioned before, when you have required minimum distributions, you got to take the money starting out on 70.5. Otherwise, they can hit you with an excise penalty of 50%. The difference between what your distribution amount is and what you actually receive, that difference is going to be at 50%. Keep that in mind. Let's talk a little bit about a Roth IRA. Now, this one is probably a much more tax-advantaged item to an individual. Now, while you cannot claim contributions of what you make in the Roth on your tax return, here's the advantage that helps you later. As long as the money is in your Roth, as long as you are 59.5 years old, and the monies have been in there for at least 5 years, any distribution to you becomes tax-free. Why? Because you've put the money in after tax. So we're not going to double dip in those cases. There are certain distributions, though, that could be considered taxable. If you're getting an early distribution with no known exception, a qualified distribution, or a distribution where an exception applies, those items you have to look at very carefully. If it's an early distribution, typically you're going to land up having tax. If it's a qualified distribution, you've met that 5-year, 59.5 rule. 5 years in the plan, 5 years money has been in the plan, and you're age 59.5 or older. If it's a certain code for an exception is applying, some of the number of exceptions I talked about just a few minutes ago, then when you get your W-2, your 1099 R form, which you also see for pensions, you will see it for an IRA, you're going to see those codes as well as an X where it says IRA plan, IRA SEP simple plan. There are no rules regarding required minimum distributions. That means you can put money in at any age. The $5,500 and $6,500 rule maximum, or the lesser of your taxable compensation, still applies. That's the most you can put in a regular basis. You can convert money from a traditional IRA into a Roth IRA. It is taxable at the time of distribution to you, but you're not going to be hit with a 10% additional penalty, and that doesn't matter your age. As far as any AGI rules to a Roth contribution and how much you can put in, if you're married, joint filing a joint return, or a qualifying widower, if you make less than $184,000 and you're 50 or older, you can contribute up to $5,500. If you're 50 or older, it's $6,500. So you can do the max. If it's between $184,000 and $194,000, it's going to be reduced. If you make more than $194,000, you can't contribute to a Roth. The key to these numbers, you have to be working or getting taxable compensation. When you do that, then the rules apply. If you're filing separately, you only can make between $0 and $10,000. If you're single, head of household, married separately, and you didn't live with your spouse during the entire year, anything up to $117,000, you can contribute up to the maximum amount. If you make over $132,000, you can't contribute into a Roth IRA. And in between, everything is considered partial. One of the best things I will tell individuals, honestly, having retirement plans is pretty simple. Try not to take money out before 59 and a half, if at all possible. If you have to take a loan against your plan, check with your plan administrator, one, that you can do so. Two, a loan is not going to be taxed unless you close out the plan that you are in. So for example, if I took a $10,000 loan on my earnings, which were $50,000 at the time, as long as I repay back that money into my plan, I will not be taxed on those payments. However, if I still have an outstanding balance of my loan, we'll say $5,000, and I decide to withdraw all of the money from my plan, maybe I'm retiring at that point, the remaining part of the loan is considered a distribution. And as such, it's going to be taxed as a distribution when I get the money. So if you take a loan, the best thing you want to do is try to repay that back. Repay yourself back is what we usually tell people. It is a way to get around tax in that respect. The interest rates sometimes on the plans are relatively better than banks can be. At least that's what most people will tell us. However, on a tax level, just remember, if you take a loan, as long as you repay it back, then there's no taxable consequence on that loaned money. If, however, you close out your plan and have the tax, I have a distribution with that loan still outstanding, that's going to be part of your distribution. It will be taxed. So keep that in mind. Okay, one of the last things we want to talk about today is we're going to talk about Social Security, retirement, and the like. Most people know, or should know, or believe actually, that Social Security is not taxable. That's not true. The only two items of Social Security that are not taxed are SSI, Supplemental Security Income, or the $255 death benefit that is paid out at someone's death to a beneficiary, what they used to call a funeral benefit to an individual. Those two items are never taxable. Those two items never appear on a tax return. People who get Social Security, survivor benefits, receive Social Security disability income, those benefits can be taxable. How? If you are on Social Security, do not receive any other income, no pension income, no distributions as such, no stock sales, and you exceed a certain amount of money from all of your income combined based on your filing status, if you exceed a certain base amount, then your Social Security income then will become taxable. And we see this often. I see people who are on Social Security on a regular basis, and they get a very huge pension. Their benefit may be small. It could be $4,000, $5,000. Maybe they've gotten $60,000 or $70,000 paid out to them from pensions or multiple pensions. They come to find out their Social Security, which they believe would be non-taxable, becomes taxable income. Depending on what tier of benefit it is, in other words, they'll look at certain calculations comparing your income, your spouse's income, or combined, if you're both receiving Social Security. That's going to determine if that benefit becomes taxable. And again, it can be up to 85% of a benefit. And that's large. That sometimes can be a shock to somebody when they're getting pension income. Now remember, Social Security does allow you to voluntarily withhold taxes. You have to complete what's called the W-4V, or voluntary, with the Social Security Administration. When you do that, contact Social Security directly, visit your local office. You can go online, www.ssa.gov, or call them, 1-800-772-1213, and ask them if you can voluntarily withhold taxes from your benefit. They typically will ask you the question at the very beginning when you apply for any benefits. If not, ask. If you want taxes withheld, they'll take out at least 10% of your benefit. And remember, that helps you later when it comes to payments that appear on your tax return. 1099 SSA form is what you should receive. You'll see your benefits paid, anything paid to Medicare, whether it's Part B or Part D, which is your prescription benefits. It will show if you've had to repay money back. And again, it will show if you voluntarily had taxes withheld. But remember, Social Security, for the most part, is taxable if you get other income. Now, we've done a lot of numbers. We've done a lot of information about retirement income, where it's going to show on your tax return, how it's going to affect you for taxes. Next year, when you come in to file, the new tax rates, the new tax laws are going to take effect. We have over 500 pages of new tax law. We, as tax preparers in general, are still trying to wrap our heads around to know what's going to help you, what's not going to help you. We encourage you, I encourage you, two things. You have 25 days or so from the date this is recorded and shown live to get your tax returns filed. You were looking after today. Remember, you have until April 17th to file your return, potentially file an extension, and don't forget, all that means is you're filing your paperwork later. You have 6 months to do so if you file an extension. But it is not going to stop paying whatever tax you owe on your returns. Just keep that in mind with an extension. But you have the time to get your 2017 taxes filed. Then the key is going to be to look at next year. What we suggest, what I am happy to suggest, is you contact us at your Liberty Tax office. You can reach any office by calling our toll-free number, 866-871-1040. Again, 866-871-1040, and you can reach the nearest tax office closest to you, make an appointment. In many cases, walk on in. We're glad to take you at any of our offices, and we'll discuss your tax return. We'll even look at your prior year, and we'll even look at your current year if you filed at another location for free to see if we can help you save additional monies or to make sure the return information is correct in and of itself. We're happy to do that. We're also happy to do this sort of presentation with your group, your organization, whether you're with a church group, if you are a senior group, your business, not just on this topic, but a number of topics that we can make available to you. We're more than happy to come out, make a visit, talk with you, answer your questions. and be a part of our Liberty Tax Talk program. Again, you can reach our local office here in Suisun, California. You can contact me directly. My email is Anthony.Fagen. That's F as in Foxtrot, A as in Apple, G as in George, E as in Edward, N as in Nation, at libtax, libtax.com, or call our office locally, 707-422-1800, or by all means, if you're not in the Suisun area, call our toll-free number, 866-871-1040. Speak to our local office, and we'll be more than happy to come out and visit you out there. And again, do these tax talks, which we do absolutely free. The other thing we want you to do as part of this presentation is give me a shout by email as well to let me know that you've watched it. If you have questions, if you have comments about the presentation, if you even like the idea about the presentation and how we've done it, I'm more than happy to give you information about it. We also want you to participate in what we call a Liberty Tax Talk survey. To do that, go to www.libertytaxsurvey, all one word, .com. Answer a few questions about the presentation you saw today. It will ask you for a store number. The store number is 15746. Again, 15746. And let us know there about how you felt about the presentation. If you'd like more information, if you'd like to contact the local office to get an appointment scheduled, we're more than happy to review that information. And we, as office supervisors, will get that directly so we can call you, schedule your appointment, and get you into the office. So with that, that is our presentation today on retirement and taxes. I know we've given you a lot of information to digest. Please, by all means, reach out to us at libertytax.com. Call our local office here in Suisun or call 866-871-1040. And give us some ideas of what you want to see in future presentations here online. You can reach me at anthony.fagen@libtax.com. Let me know what you'd like to see out here, and we're more than happy to put something together for you. Once again, thank you so much for joining me, and have a pleasant day.